Hey, good morning, everyone. Marty Mazura here, June 17th, Wednesday, 2020. This will be your weekly message. As I mentioned on the morning note, and I've kind of been prepping you for the last few days, I want to talk to you for a few minutes this morning about volatility, historical volatility, and what it portends for the market going forward, actually right now, in fact, and going forward. So I want to start with the screen in front of you. That orange line is the high yield credit spread. This is actually one of the components in our PWA macro index because it is telling about the state of the economy or the state of the economy at any given time. Notice that I have this red line drawn right here at 5%. And then you'll see why I've got these shaded areas here in a second. But the definition of the high yield credit spread, in this case, I'm using a 10-year junk bond index versus the 10-year treasury. And the spread is the difference in yield. So the difference between the aggregate yield on the index for junk bonds versus the 10-year treasury. When it goes up, obviously, what that says is that the yield on junk bonds is rising relative to the yield on treasuries, and then vice versa when it goes down. There's a reason why I have above 5% here, and you'll see that in a second. So as the credit spread or the high yield credit spread widens, that says something about financial conditions. Essentially what it says that on lower quality corporate bonds, investors are demanding more for the risk relative to treasuries. Okay, as you can see right here, junk bond yields spiked big time, not 2008 level, but they spiked big. And the Fed stepped in. In fact, they stepped in this week and added to what they can do in the corporate bond space. And that's really calmed the market down. However, a yield above 5%, 5.46% as of yesterday, is not a comfortable place to be. That's a historically high credit spread, and it says something very negative about the state of the economy. Obviously, the state of the economy is going to reflect on companies that are already struggling, therefore they have the poor credit rating, to make their debt payments or to service their debt payments. Now, just to help you understand, and I've written about this a lot, the signal that the market is taking from all of this Fed money printing and buying of corporate bonds, frankly, is not the right signal. Well, let's say it is and it isn't. From a pure security standpoint, securities as in traded securities like stocks and bonds, yeah, I guess it's a legitimate signal to say, have at it, folks. Take all the risk you want, because at least in the junk bond space right now, the Fed is not going to let you lose any money. Okay? Well, the issuers of those bonds, the corporations themselves who have issues, this does not alleviate them of the responsibility. It alleviates the investors, private equity firms, hedge funds, etc., of the risk of losing money on what have really been risky bets. And for quite some time, well over a year, we've been writing about the risk there and how that when that risk comes to the surface during the next recession, which we're now in my candid view, you could not avoid something along the lines of 2008, in my view, frankly, probably worse. Of course, the Fed realizes that. And while they were telling us last year and throughout that the economy is great, better than it's ever been, well, when you read the Fed's own financial stability reports that come out on a quarterly basis, their economists clearly did not agree that we had very low risk in the system. And then our own data was showing real fragilities that said that a recession over the next couple of years is far more likely than continued expansion. And then again, to repeat, the dynamics in that recession that have to do with corporate debt was going to make it a really, really bad one. Well, folks, unfortunately, while the Fed gives the impression that, hey, we're there to provide liquidity to markets, true, markets love it, but it doesn't provide the wherewithal for companies to make legitimate revenue, create that, to pay debt service payments that they were about to fold on anyway, even before the recession in many cases. So they're bailing out big investors, and the losses that are going to come, and I featured, the bankruptcies so far on companies over 500 employees last night on the blog. The taxpayer folks, unfortunately, you and me, get to pay for those losses on those defaults. It's showing up in a special purpose vehicle. It's basically a taxpayer funded, ultimately, vehicle to buy these junk bonds, to save these portfolios. And then you and I higher taxes, lower value of the currency later, and so on. So anyway, just to help you understand, and more importantly than that, we can get upset about that. We can talk about inequality. We can talk about the next Wall Street Occupy demonstrations that are likely to come over the next 2 or 3 years because of this. Or we can simply focus on what we're worried about right now, and that is the fact that this insolvency phase that has already begun is going to have to play itself out without regard to the Fed printing money. In fact, what they're doing is that, in my view, they're making it worse because, as I said also in yesterday's blog, there's been $1 trillion of new corporate debt issuance. You can thank the Fed for that. That's just enhancing or exaggerating or inflating the bubble right back to where it was, if not bigger than it was before. Having said that, we are seeing some bankruptcies. We are seeing defaults. We're going to see a lot more. So it's kind of a combination of the two. But at the end of the day, like I said this morning, the Fed cannot print jobs, right? And it cannot print sustainable revenue. They can create cash for companies, but that's not sustainable revenue as a result of a good economy and good business. So, okay, so off of that soapbox, let's get back to what our studies are. So we've been looking at 100 years of volatility in the markets. Some things like this high yield credit spread, you can only go back so far, 1987 it looks like. So again, spreads above 5%, as you're going to see in a minute, become problematic. Okay, so I talk a lot about the VIX index, and this is where this gets really noisy to look at, and I apologize for that. So the VIX index tracks the cost of implied volatility, something we're very intimate with, in options contracts, the near the money or at the money S&P 500 contracts. And that's a very key element in the pricing of options. The VIX was established after the 87 crash to kind of give us an indication of risk in the system and so forth, or risk in the options market and therefore the stock market. So this line also pretty much just above 20 on the VIX. The VIX is on the left axis over here. So now the highlighted area that you see here is where the VIX is above 20 and the high yield credit spread is above 500 basis points or 5%. So I highlighted those, and you'll see why, right in here for the life of both of these indicators, okay? Now I'm going to fold in the S&P 500 index. Okay, so the white line, the thick white line here, that's the S&P 500. So I want you to note what happens when the VIX is above 20 and the high yield credit spread is above 5%. Volatility like crazy. Now we know that with the VIX above 20 anyway, but add in the high yield credit index and you basically have what I would call an uninvestable market if you're looking to game this thing on the long side, certainly a market to short perhaps, because without exception virtually, and I don't think there is an exception here, there's a little, I missed this one, but see what happened right in here. You get some pretty noticeable downside volatility when you're in this regime. And right now you are at a VIX of 34, so way above 20. And then, as you can see here, a high yield credit spread of about 5.46. So we are well within this range. And by the way, the credit spread has bounced and come up, as has the VIX. It's been bouncing all over the place. But again, both of these, and for 5.5, that's comfortably above, and it's been there the whole time on the high yield credit spread. So to make that a little easier to look at in terms of the S&P, I say easier, but what I did here is during each of those highlighted periods, I illustrated for you the dip in the market within that period. 20%, 22%, 50%, 58%, 17%, 20%, 10%, 15%, 20%, and 35% so far, respectively. So folks, at the end of the day, forget about macro, don't forget about it. But the things that we talk about over and over and over again and all the different angles that I share with you on the blog, this is really for you clients to understand why we're staying hedged, why we're staying guarded right here. But if you just looked at this one particular indicator, every single time so far that you have real serious trouble in the stock market when you're sitting within this volatility regime that has to do with the VIX and then the high yield credit spread, where it sits right now. So no, on top of everything else that we're concerned about, I'm going to share a little bit more with you. No, we do not want to be aggressive at all in this particular environment. With just the S&P 500, we can go back almost 100 years, and I'm going to go back as far as I can here to 1927, which is just past that. So now we're back to the Great Depression, believe it or not, on this in this particular graph. This is the daily rate of change for the S&P 500. Now let me pull this down, and I want to focus here on this really big volatility. I drew lines 5% below and above and 3% below and above. And I want to illustrate for you kind of the clustering effect and what tends to happen. Now, the first thing that jumps out at me about what we're experiencing right now is we have something that looks very similar, at least at this point, to the experience in 1987. Not as far to the downside. We went down 22% in one day, but we've had some big down days and we've had some big up days. That's what this yellow line represents, right? But the 1987 experience actually came and went, and you can see volatility really calmed down in this range. We had one big day here, until we got into, the 1990 recession, and I just showed you to the extent that the market went down there. But it kind of came and went. Didn't really cluster and stay there. Well, having gone back and looked at this year after year after year, when we were in recessions and we had this kind of volatility, it lasted longer, and the market, for the most part, the bear market, was worse in terms of length of time, and the last two certainly worse in terms of degree, 50 and 57% respectively. We have an economy right now that arguably is worse than both of these combined. This was actually a mild recession, but we had a tech bubble that needed to be taken care of. We actually have similar valuations, in some cases as higher valuations than we had here. And ironically, we had a real corporate debt mess here like we have right now. Here we didn't have high stock market valuations or a corporate debt mess. We had a mortgage mess, essentially, and high residential real estate valuations. Very different recession. This one looks very much like, this one today looks very much like the late 1990s, early 2000s, actually the 2002 recession. And look at all that volatility that began back here in the mid-90s and lasted throughout. And, we had a devastating bear market there. Look at the volatility that began, back in the, as we were getting closer to the real estate bubble bursting. You're getting signals in here. Got to pay very close attention, and we can zoom really in. We won't do that now. And really see signals and similarities within what looks like just a ton of noise when you look at it this way. Okay, so but when we go back and we zero in on an area like this, historically, what else looks like that? Well, you can say that you got this period in here that it looks like that, and it clustered and it got a lot worse. You can say that. You can also say that it looks a lot like the Great Depression experience, and I'm gonna not do as good a job as I could, but I've been pulling this apart. And when you look at focus on this look right here, and then take it back to where we are here, and it's a very similar look. I'm not saying we're going to have this kind of a market, but I'm very skeptical of the notion that a lot of people are putting forth that we're ultimately looking at this kind of a market. I just don't see that, largely because why? There's no recession up in here. There's no big fundamental mess in the economy. There were issues, certainly issues that had to do with portfolio leverage and things like that, fancy, modeling and supposedly risk management that went awry. There's been some of that over the last few years here as well, but you did not have an economic recession, just like we didn't here when we had this big dip where we stayed growthy the whole time. You know, up in here, as I keep telling people, we got defensive before the market even peaked because our data was saying things look pretty ugly. So folks, we're looking at a period of a lot of volatility. My best guess is it's going to last a while. My base case is that we have not seen the worst of the bear market yet. I just showed you some volatility statistics that suggest that not necessarily that things are going to fall apart, but are we not in a very risky period right now? Okay, a couple other things just to wrap up. Take a look at this. This is a note from the International Monetary Fund's top economists yesterday. And I just wanted to point this out because it's exactly what I've been saying. A striking divergence of financial markets from real economy could portend greater volatility in the markets, possibly sharp corrections. So you know that that's our base case. I'd say sharp corrections might even be putting it mildly in terms of what the risk is right here. And then lastly, Thomas Thornton, very smart guy, hedge fund telemetry is his firm. They do a lot of good work and they're modeling portfolio rebalancing. Now you may recall we were talking a lot about that in March. And that was, in March the market had fallen apart till late in the month. And March would be where a lot of quarterly rebalancing happens. And we're talking about the fact that there's probably going to be some buying support for the market. Pension funds, for example, got utterly crushed from the February top to late March. And so when they have a target to equities and fixed income, guess what? You sell the fixed income and you buy the equities because they're down 35–40%, if not more, depending on the fund and what they were in. Well, guess what? We've had a 40+% rebound, and here we are at the end of Q2. So Tom Thornton is basically saying that they're starting to get estimates from the June quarterly monthly pension rebalance. Okay. Their model estimates 76 billion of equities to sell, which he suggests is the largest ever. So that makes some sense to me. Now, a lot of smart people are calling for Q3 to be where the market really begins to express what's going on or reflect what's going on in the real economy. And Q3, ironically, happens to be some of these areas here. Many of them happen in Q3 when you see this intense volatility. So folks, I'm not making a short-term prediction. I'm just not. But don't be surprised if we get an exceptional amount of volatility, not that we haven't had a lot already, and that a bunch of that is downside volatility in the third quarter. Whether or not that happens in the third quarter, the fourth quarter, the first quarter of next year, or if it happens at all, for you clients whose money we manage, what I'm doing over and over and over again, and I'm doing it here today on the blog, is just illustrating for you why this is not a market at all like the market that we were very growthy in from the bottom of the last recession all the way to late last summer. We felt very good about our exposure. We stayed in there right through the corrections because all of our analysis said everything's fine, correction within the context of an ongoing expansion bull market, all the way through that big one in the fourth quarter of 2018. Unequivocally, that is not the market that we're in right now. This is a market to be careful in. And we're going to continue to do that until we have evidence that suggests it would be smart to do otherwise. I'll leave it there. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.